The Federal Reserve's interest rate decisions have a direct impact on U.S. households, influencing everything from mortgage rates to credit card debt. When rates rise, borrowing becomes more expensive. When they fall, saving becomes less rewarding. Here are the top 10 ways the Fed's interest rate decisions affect American households. 1. Mortgage rates fluctuate. Interest rate hikes increase mortgage rates, making homeownership more expensive. A higher rate on a 30-year mortgage can add hundreds of dollars to a monthly payment. Conversely, when the Fed lowers rates, mortgage refinancing becomes attractive, reducing monthly payments. 2. Credit card debt becomes more costly. Most credit cards have variable interest rates tied to the Fed's benchmark rate. When rates rise, credit card debt becomes more expensive, making it harder for households to pay down balances. A decrease in rates provides relief, allowing consumers to save on interest payments. 3. Auto loan costs shift. Car loans are also affected by interest rate changes. Higher rates increase monthly car payments, making financing a new vehicle more expensive. Lower rates, on the other hand, make auto loans more affordable, boosting car sales and leasing options. 4. Savings account and CD yields change. When the Fed raises interest rates, banks offer higher returns on savings accounts and certificates of deposit, CDs, benefiting savers. However, when rates drop, interest earnings decline, making it harder to grow savings through traditional banking products. 5. Inflation may rise or fall. Interest rate hikes are often used to control inflation, helping households by keeping prices in check. However, when the Fed lowers rates to stimulate the economy, inflation may increase, leading to higher costs for groceries, gas, and essential goods. 6. Student loan interest can increase. Federal student loan rates are set yearly, but private student loans are often tied to variable rates, meaning Fed rate hikes increase borrowing costs. Higher rates extend repayment times and add to overall loan balances. 7. Stock market and retirement accounts are affected. Interest rate changes impact the stock market, affecting 401(k)s, IRAs, and investment portfolios. Higher rates often slow down stock market growth, while lower rates boost stock prices, influencing retirement savings. 8. Home equity loans become pricier. Home equity loans and HELOCs, home equity lines of credit, have variable interest rates. When the Fed raises rates, monthly payments on these loans increase, making home renovations or debt consolidation more expensive. 9. Rental prices may rise. When mortgage rates increase, fewer people can afford to buy homes, leading to higher demand for rentals. As a result, landlords may raise rents, making housing less affordable for renters. 10. Job market and wages can be affected. When the Fed raises rates aggressively, businesses slow hiring due to higher borrowing costs, potentially leading to job losses. Lower rates stimulate business growth, increasing job opportunities and potential wage hikes. Federal Reserve interest rate decisions impact nearly every aspect of household finances, from mortgages and credit cards to savings and investments. Understanding these effects helps individuals make informed financial decisions, adjust budgets, and protect their wealth in changing economic conditions.